why your money is worth less every year, and who's benefiting. Inflation is a term frequently tossed around by economists and politicians, yet its direct impact is felt most keenly in everyday life. Simply put, inflation refers to the gradual increase in the prices of goods and services, reducing the purchasing power of your money over time. This silent economic force means that the dollars you earn today may buy significantly less tomorrow. Understanding inflation begins with examining its root causes. One major factor is the expansion of the money supply, particularly through practices like quantitative easing, where central banks introduce more money into circulation. When there's more money chasing the same amount of goods and services, prices inevitably rise. Another significant contributor to inflation is demand pull dynamics. This occurs when demand outpaces supply, often due to strong economic growth or supply shortages. The COVID-19 pandemic illustrated this vividly. Supply chain disruptions combined with substantial consumer demand drove prices upward sharply across sectors such as housing, automobiles, and groceries. Cost-push inflation also plays a crucial role. This type occurs when production costs increase, whether from higher wages, raw materials, or energy prices, forcing businesses to raise prices to maintain profit margins. These incremental price increases compound, eroding consumer purchasing power steadily over time. The practical impact of inflation is clear in everyday expenses. Essentials like food, fuel, healthcare, and education see consistent price increases, making it increasingly challenging for individuals and families to maintain their standard of living without corresponding wage increases. For those on fixed incomes, such as retirees, inflation can drastically reduce quality of life, pushing many into financial vulnerability. Savers, in particular, are disadvantaged by inflation. Money sitting in traditional savings accounts, typically earning minimal interest, gradually loses value over time. If inflation outpaces the interest rate, the real value of these savings diminishes, effectively penalizing those who save conservatively. However, inflation is not uniformly detrimental. Specific groups and sectors can significantly benefit. Debtors, including both governments and individuals with substantial debts, often gain from inflation. As money devalues, debts incurred at previous lower-value dollars become easier to pay back with newly inflated dollars. This dynamic can incentivize borrowing, particularly for investments such as property or business ventures. Asset owners typically see gains during inflationary periods as well. Real estate, commodities like gold or oil, and certain stocks tend to appreciate, reflecting rising prices in these sectors. Property values, for instance, frequently rise with inflation, increasing the net worth of homeowners and investors holding real estate assets. Governments can also benefit strategically from controlled inflation. Moderate inflation levels can help stimulate economic activity by encouraging spending and investment rather than saving. Additionally, governments find inflation useful in reducing the real burden of public debt. Inflation effectively shrinks the value of debt obligations over time, easing fiscal pressures without explicit default. Financial institutions and corporations often navigate inflation effectively by passing increased costs onto consumers through higher prices. Large corporations with significant pricing power and market dominance can maintain or even boost profits despite inflationary pressures. Small businesses lacking similar leverage may face greater challenges, contributing further to economic inequality. Mitigating inflation's adverse effects requires proactive strategies. Diversifying investments into assets that historically outperform during inflation, such as real estate, inflation-indexed bonds, commodities, and equities, can offer significant protection. Regularly reassessing financial strategies and adjusting budgets to account for inflation can also preserve purchasing power and economic stability. Moreover, improving financial literacy can empower individuals to better understand and respond to inflationary trends. By recognizing inflation's impact, people can make informed decisions about saving, investing, and spending, safeguarding their financial futures. Policy measures also play a critical role in managing inflation. Central banks often respond to rising inflation by raising interest rates, aiming to reduce spending and borrowing, thus cooling the economy and stabilizing prices. While effective, such policies must balance the risk of triggering economic slowdown or recession, illustrating the delicate nature of managing inflationary pressures. In conclusion, inflation steadily erodes money's value, impacting virtually everyone, but benefiting specific groups like debtors, asset owners, and governments. By understanding inflation's causes and effects, individuals can take informed steps to protect and grow their wealth. Strategic financial planning, prudent investments, and informed policymaking collectively provide effective tools to navigate and mitigate inflation's impact, ensuring financial resilience in an ever-changing economic landscape.